Hello, viewers. Welcome to part 4 of Accounting Fundamentals. So, in this session, we will be exploring or discussing about the second part of your financial statement, that is your profit and loss account. Now, in the previous session, we understood the components of balance sheet, and the last session we discussed about the various components or the subgrouping of the assets we learned. And in this session, we will discuss about the next uh, financial statement, that is the profit and loss account, right? So in the earlier session we had discussed about the difference between these two financial statements, right? And we also discussed about the different type of information that each of this financial statement is going to produce. So the balance sheet basically is going to give you the position of companies assets and liabilities on a particular day. So that is why we said, the statement which says is balance sheet as on, or it says as at. Now, profit and loss account, one, if you see the statement, the profit and loss account that you read, it says profit and loss account for the year ended or for the period ended. So basically, it gives a period. So what is this period? And very clearly it says for the year ended. So that means the profit and loss account is a statement which is like your marks card of your performance for that particular year. So profit and loss account, takes into consideration the entire income activities that has happened or the entire income that you have generated for that particular financial year. And it also takes all the expenses that the company is incurred, including purchases, right? And the net of the income minus expenditure is what is the result of your operation. Now, how do you arrive, or what is the formula that generally we apply for arriving at profit and loss, or loss, profit or loss? Okay? It's very simple. So, income minus expenditure, the result is going to be either profit or it can be a loss. Okay. So if there is an excess of income, then the company has made a profit. So when I say excess of income, that means your income is more than your expenses. For example, let us say your income is 10 lakh rupees for this particular financial year, and your purchases plus all your other operating expenses constitutes, let us say, 8 lakh rupees. So in this case, there is 2 lakh rupees of excess income. Okay. After reducing the expenses from the total or the gross income that you have earned, the balance of that is what is the result, which is your profit. So in this case, you have 2 lakh rupees profit. Now, supposing, let us assume that your income is 10 lakh rupees and your purchases and expenses is 12 lakh rupees. So in this case, there is an excess of expenditure over income. So which is a result, that is, you have incurred a loss of 2 lakh rupees. So what happens to the income, uh, which means the profit or loss, right? So the P&L account basically gives you the net result, which is profit or loss, right? So it is, considering the entire income, reducing your expenditure, and the balancing figure is your profit or loss. Now this is the figure which goes into your balance sheet. That is why, right? So year on year, the closing balances or the balances as on the last day of your financial year will automatically get carried over to the next financial year. So that is how your balance sheet will says, okay, at end of every financial year, your operation for this particular financial year, you did a very good operation. You were able to manage your business very well. So you earned a profit of 2 lakh rupees. Now that profit is going to go and sit on which side of balance sheet, right? Which side? Right. I think many of you are right. So it goes and sits on the liability side of the balance sheet, because the profit that the business is earning is basically the reward the business needs to give to the owner of the business or the person who's introduced capital, because that person has to get return on investment, right? So that is why the profit that the company earns is considered as liability of the company. So including that is what, I mean, like, you carry forward to the subsequent financial year, all your assets and liabilities, and then again the operation continues and goes on and on as long as your business is running. So we will see what is this profit and loss account, and how do we define this profit and loss account, and what is the function of this profit and loss account, and we know what the result the P&L account is going to give us, right? So P&L account is a statement that reports the company's financial performance in terms of net profit or loss over a specified period of time. Now, this is what I had explained to you, right? So, again, if you see, in case of a manufacturer or in case of a trader, you have something called as gross profit. There are two types of profit. Okay, so one is gross profit, the other one is net profit. So we need to understand what do you mean by gross profit and what do you mean by net profit. So for us to understand this is what we will see. Again, we know that P&L account is going to have two sides. Okay, so you will have income side, which is going to represent on the right hand side, and you will have expenses side, which is going to represent on the left hand side, right? So these two sides go to constitutes all your incomes are captured on the right and your expenses on the left hand side, right? So first what we will do, we will try and understand, like we understood the components of balance sheet. So in this session we will see what are the different types of income that are there and how the income of the business are generally classified. Okay, so with this basically we will now understand, once we complete the understanding of the income and the breakup of the income, expenditure and the breakup of the expenditure, then we will know that what is the relevance of this gross profit and what is the relevance of the net profit. So we will refer to that once we complete these understanding these two sides. Okay, so now let's first take the income part of it. Okay, so what is an income for a organization? The amount of money or its equivalent received during a period in exchange for goods, services, labor, or sometimes you get an income out of sale of property, right? Or you make a profit, or there is an income out of financial investments. So in the previous one, in the current asset, we saw investment and deposits. So the interest that you're earning, or the dividend that you are earning out of your investment, or the interest that you are earning out of your deposit, is also part of the income of the organization. So like this, one, there is a major income for the company, which is your sales. Then there are other associated income. So we have to now, it is very important that we identify these income and then classify them appropriately. So how does the income gets classified in your P&L account? So again, broadly, all incomes of the organizations are classified into direct income and indirect income. So it is important for us to understand, like, what constitutes direct income, what are the things that you will have to consider as part of your direct income, and what are those other incomes which uh, are in the nature of indirect income, and how would you now report them. So first let us try and understand the direct income. So this is a very important statement which we have to remember. So what are the items that constitutes direct income? It has to meet this criteria. So what is this criteria? The criteria is all incomes that are related directly to the business, and it has to be regular in nature in the course of business. So, what do we understand by this statement? See, the statement says very clearly you are starting a business, right? And your main business activity is trading, or if you are a manufacturer, you're going to manufacture your finished goods and you're going to trade that finished goods, right? So the objective or the intention at which you start your business clearly says that what is your nature of business transaction that you are dealing in, right? So any income that the organization earns out of this major activity of your business, and those income which are regular in nature. For example, I am dealing in consumer durable products, right? So I am going to now, as a trader, let's assume that I'm a trader. I'm trading in consumer durable products. So what am I going to do? I am going to buy those products from the manufacturer or from the distributor or from the wholesaler. Okay, and then I am going to sell these products. So this is going to be my main activity of my business, and this is the income that I would be earning on a regular basis, right? So that is what is your direct income. Now associated to your direct business, right? So there could be other kind of interest which are in relation to this condition. That is, it should be regular in nature. It is not that once in a while you're going to get it kind of a thing, right? And also, I mean, like, it has to be as part of your main uh, business activity, right? So let us see what are the examples of direct income, so that you will get more clarity. So very simple, the examples of direct income. The major income for an organization is basically out of your sale, which is what just now I gave an example, that you buy products and you sell products. So all those sales that you are doing is basically your income for the organization, and this is your primary income. And definitely these are the income which are going to be regular in nature. Maybe you might not have daily business, but in any case, I mean, this is your main source of revenue, right? Then in case of a professionals, then professional or consultancy charges is going to be their main source of income, which is a direct income directly associated with my business. Okay. Then the other things which you will consider as part of your direct income are the discounts that you are receiving, right? So the cash incentives that you are receiving, rebates that you are receiving. Generally, if you see in this consumer durable goods, you must have like heard that maybe some of your relatives who are running this consumer durable showroom, or friends, or your friends' parents, right? So you must have heard your friend or your relative saying that, okay, so generally what happens, after the end of the financial year, I mean, like, once in a year, the distributor or the manufacturer is going to take them on a foreign tour. Okay, so those are the incentives which are not in monetary in nature. Okay, but in other cases, right, so various other principal supplier or the manufacturer, so they will be having a different or multiple schemes, basically to motivate the dealers to, I mean, like, push their product more in the market, and also help them achieve their target, right? So to motivate these people, generally, companies, what they do is they might be having some kind of a discount scheme, which means it could be a quantity discount, or it could be an amount discount. For example, companies can say that, okay, in this particular financial year, if you are picking up more than x number of items, like, for example, if you are able to, sorry, if you are purchasing, say, 500 and above, right? So then they'll say, okay, we will give you a 2% discount on all your purchases that you have made is one thing. Now this again, you have to see that the interpretation is very important. This discount you are receiving due to the activity of your main business activities, right? So that is why this is considered as a direct income. Now similarly, cash incentives, right? So based on your turnover, let us say there is a target set by the manufacturer. He says, okay, if your turnover of turnover in the sense, your purchase, if your purchase value, if it exceeds 10 lakh rupees in a year, right? So then they will say, we will give you a cash incentive of 2% on the value of your purchases. Now this again is an additional income for the businesses which are associated with the direct course of business activity. So similarly, rebates. Okay, so probably I mean, this would help you to comprehend and understand that, okay, so anything which is related to my business and which are regular in nature. Now again, when you don't go literally by regular in nature, because generally if you see the discount received or cash incentives may be happening once in a quarter, once in a half yearly, or once in a year. But then again, if you see, this is something, a practice which is regular in the business, year on year you will have it. So that's the consideration that you have to keep in mind, right? So these are your direct income. Okay, now we will see, okay, if these are my direct income, what are my other indirect income, which I need to maybe segregate them and then tell them that, okay, so apart from these income, these are my indirect income. And what is the criteria that you apply to consider a particular income as an indirect income? Let us see. So the statement says, incomes that are not regular in nature. Okay, now this is why I made a statement that though your discount received or cash incentive or rebate might not be month on month or something, but still it is associated with your main business activity. Now in this case, I will give an example. So in this case, it says income that are not regular in nature and are not directly related to your business activity. A very simple and easy example for us to understand the statement is that, let us take the example of the FD. So I had, in my previous session, I had mentioned about that you have excess money in your current account, and your current account is not going to give you any interest for the money that the bankers are using your money. So what you do is you take a portion of your amount fund that is there in the bank, and then you take it FD, right? And now, on maturity of the FD, whatever is the period of FD that you have taken, on the maturity of the FD, for the money that the bank have utilized your money, so they now compensate with an income return on your investment. So you are investing in the bank, so as a return of your investment, the banker is now going to pay you certain percentage of interest on the money that was lying with them where you have taken an FD. Now that interest that the company is earned, okay, that is an income for the organization. But now we'll have to now apply this criteria and then see, okay, so is it regular in nature? Maybe. Okay, every 3 months or every 6 months you will do it. But is it related to your main activity or main course of your business? What is your business? My business is to deal with consumer durable goods. My business is not to deposit money in the bank and earn interest. That's a different business, right? If in the context of the business's core activity, you have to apply this criteria and then segregate your income into two types, right? So these are income which are not, generally it is not regular in nature, and it does not constitute towards my main activity or core activity of my business. So let us see what are the other examples, so that it becomes easier for you to understand, so that it becomes easy when you are now accounting, or when you are now managing the accounts of the company. It becomes clearer for you to put them in the right groups. Okay, so what are the other examples? The other examples of your indirect income are interest on deposit, right? So this is what is the example that I gave you. Then sale of asset, right? So my asset, so any asset, like for example, I take a machinery. When I buy a machinery generally has a life term, right? Generally between 5 to 15 years is what you have a life term for a machinery, which means basically the effective productivity that the machinery is going to give you, okay, will last for a certain period of time. And post that time, then what happens, the productivity efficiency and the productivity level is going to come down. So in that case, you are now going to probably replace that equipment or replace that machinery, right? So now, for the benefit, I think in our previous session we were discussing about depreciation as part of our expenses, right? So that is the reason why the income tax department or companies act, allow the companies to claim depreciation. So the whole idea of depreciation is, I think, is the right time to discuss here. The whole idea of depreciation allowed by the various statute is that you set aside, because depreciation is not an, though we consider depreciation as an expenditure, it is really not an expenditure. See, the moment when you say expenditure, there is going to be a fund outflow, maybe immediately, maybe at a later point in time. But when you are now claiming depreciation, you are not claiming depreciation, which means you are not, let's say that I say that my total depreciation for this particular year on all this machinery is, say, about 2 lakh rupees, right? Now you are not going to make payment to anybody this 2 lakh rupees, right? So what the statute says that, okay, see, since the life of the machine is going to be, so based on different types of asset that the companies have in general, the companies act gives a list of rate of depreciation that the businesses can claim on those set of assets, or on the block of assets we call. Similarly, income tax also has got a thing. Now, Companies Act has got a different rate of depreciation that the companies can apply on their assets, and income tax has got a different depreciation schedule which you apply when we are basically, when you are furnishing the income of the company. The income tax says, okay, I'm going to give you this much as their depreciation. So the whole idea of giving depreciation is that over a period of the life of the asset, every year, let's say, for example, let us say income tax is allowing, or any statute is allowing 10% discount on the that particular asset that you are holding. Okay, so that means, I mean, basically in 10 years time, literally you will have enough fund with you, okay, so that quickly you can replace the asset. So that the moment you replace the asset, the idea is, see, the overall idea of this, I mean, like, the statute, or the, especially, let us take the example of income tax. The overall idea of income tax is, see, every year, I mean, like, as long as you are efficiently manufacturing, you get better revenue, you earn more profit. The more profit you earn, income tax department is going to get better taxes, right? So if some kind of a benefit is not given for the company to have a longevity of their business activity, then over a period of time, as I mean, like, once the efficiency of the production level or any other asset efficiency, which is basically going to help in better operating their businesses, if that starts depleting, so which means the end result is going to be, you will have lesser profit. If there is a lesser profit, income tax is going to get lesser taxes, right? So just to help the businesses to I mean, like, be at always at the top of the efficiency, and then produce more, earn more revenue, and pay more taxes, the income tax department says, okay, every year I am telling you that you consider the 10% of the value of your machinery as your expenditure, reduce that from your profit, and after reducing your depreciation, just give me only the net of that, considering that is your net income, and pay me taxes. So now the question that now it will come to all of our mind is that, okay, so this, I am not paying anybody this money, 10%. Let us say 10% comes to 1 lakh rupees this year as my depreciation. I'm not paying anybody 1 lakh rupees. Where is that money going? Right? Where is it? See, that money that I am showing that as an expenditure, very simple. Either that money that you are, I mean, the not money, the either, I mean, the amount of 1 lakh rupees that you are claiming as an expenditure, that 1 lakh should be in form of cash with you, or it could be in the form of money in the bank, or it could be in the form of inventory. Generally it is going to be as form of inventory, or it could be in the form of sundry debtors, right? So that is why ideally companies, what they should do is, you will have something called as a depreciation fund. So literally, if you can just pull out this money and then keep it, but then again, what happens if I pull out that money and then keep it aside? The return on that investment is going to be lesser probably. So that is why, uh, as a natural occurrence, right, whatever depreciation I'm claiming is fine, but then that much of amount, there is no outflow from the company to any third person, right? So it gets, that amount gets flowed back into the business as investment, and in these various forms. Okay, so that is basically the depreciation. Now what happens, I have depreciated 10%, 10%, 10%. Generally the depreciation is done on the diminishing balance. So that means 1 lakh is my value of the asset. 10% on that is 10,000 rupees first year. Now my book at the end of the when I'm finalizing my books of account for that particular year one financial year, my asset values now come down to 90,000 rupees. Now, next year again, I'm going to claim 10% depreciation. Now, I'm going to claim 10% depreciation on the reduced value, not on my original cost of the asset. So now, second year, if you see, 10% on 90,000 is going to be 9,000. So like this, it keeps on, reducing. So ultimately, after 10 years, your money is not going to become zero, right? Because of the depreciation calculation that we are doing on a diminishing balances, right? So let's say after 10 years, okay, so your book value shows that this particular asset is, as per book, after depreciating, let us say it is only about 12,000 rupees. I'm just giving an example, don't worry that I'm doing a wrong calculation. Okay, so 12,000 rupees is your book value of the asset at some point in time. Now you know that it is time that you cannot further continue with this. Now you have to acquire a new machinery, so that you bring the same efficiency or increase your efficiency in your production activity. So now you're going to buy a new machinery. Now this machinery in any case, okay, is not going to be helpful to you, and there is no space, various conditions, okay, various factors could decide you to sell this particular machinery. So now you're going to sell this particular machinery. Let us say you find a buyer. You are lucky, you find a buyer, and that person is, you have negotiated, and then you have fixed the price of 15,000 rupees, right? So now you are going to get 15,000 rupees. But what is the value of the asset as per your books of account? The value of the asset as per my books of account is 12,000 rupees. Now I am getting a revenue of 15,000. I'm getting a fund of 15,000 rupees. Now already there is my asset which I have to now, because the moment I sell, then the asset is not there in my balance sheet, right? So 15,000 is my income. So I'm going to get a check. So that money is going to go into the bank, right? So now you have to see what is the income. See, your book is saying 12,000 rupees, which is your cost. It is like as good as, I mean, like you're selling your normal product, right? But it is not a regular activity. That is why you are putting sale of asset, income on sale of asset, as part of your indirect income, right? So 15,000 is the income minus the cost. So 3,000 is the profit that you have made on sale of asset. So that is your indirect income, right? Again, apply this criteria, right? It is not regular. You are not going to keep buying machinery and selling machinery. Okay, if that is not your business. But if you are regularly buying machinery and selling machinery, then you are in the business of dealing in machinery. That's a different thing, right? So that is how, all the income which the organization earns out of non-regular activity, and which are not directly related to your business activity, you will classify those income as indirect expenses. So various other miscellaneous income, sale of scrap, right? Sale of, like, another very nice example that I can give you is, let us say in your office, you buy mm, newspapers, magazines. So once in 6 months or something, you now just sell those magazines to Raddiwala, right? And then, some money you get, say of 2,000, 3,000 rupees. That is an income of the business, right? So that is indirect income, because my business is not to sell newspaper and old newspaper and magazine to Raddiwala, right? So that is how you can apply this criteria, and then you can differentiate between the income which are direct in nature and indirect in nature, right? And this is one of the important factor which will help you to determine your gross profitability. Now when we come to in the next session, we will discuss about the other side of your profit and loss account, which is expenses, and then we will see how your gross profit is going to get impacted, and why this classification of direct and indirect is required. And also on the expenditure side, we will also see that there is two classification. So we will understand those classifications. We will take examples, consider examples of what kind of expenses we will be taking as my direct expenses and indirect expenses. Okay. So this basically gives you an idea of your income side of your profit and loss account, and any activity or any income or any revenue the company earns. Now I hope you will be more clearer to put them in the right baskets, right? So again, thank you once again, all of you, for staying till the end. And as usual, kindly subscribe if you are not subscribed. If you like it, kindly click the right like button, and you share it with your colleagues and friends, so that they can also get benefited out of these sessions, right? So thank you very much. See you until next session. Thank you.